Howdy, Jacob here. Today we're looking at the next company in our dividend yield screener, ticker symbol TLK. Let's look at some of the financials here. It is a $25.1 billion market cap with a $25.0 billion enterprise value. So it looks like their net debt is actually positive in the fact that they have more cash on hand than debt. And the company was founded in 1884, headquarters in Indonesia. Looks like they provide information and communication technology and telecommunication network services worldwide. Their revenue has grown from 6.8 billion in 2013 to 9.4 billion in 2022. But if you look at 2017 to 2022, you're looking at slight decrease. In fact, return on invested capital is over that 10%, which is likely greater than their weighted average cost of capital. So they are improving and increasing business ventures. Their dividend has grown pretty consistent, or not. I guess the growth hasn't been consistent, but 61 cents per share in 2013 up to 95 cents per share in 2022, and currently $1.11 with a 4.3% dividend yield. Okay, margins 70.8% to 70.4%, very flat. Operating margins actually decreased a little bit from 35.6% to 31.2%. So there's some of that debt here. So 1.7 billion long-term debt, 2 billion cash on hand with 60 million short-term investments. So that's great to see. But they do have 1,000 as well in short-term debt, or a billion. So 1.08 billion short-term debt, 1.7 billion long-term debt, and then about 2.1 billion in roughly cash equivalents. And then, but they produce a lot of free cash flow here. So that's not, their debt situation is not concerning. Their 5-year average free cash flow is probably $2 billion. And their long-term and short-term, it combines for less than 4. And so less than 2 years on their heavy interest-bearing debt outside of capital leases. So that's not concerning. It looks like their use of cash flow changes by year, obviously, but very little going towards acquisitions. Most of it is not. A bit going towards investments. Really none going to common stock. They actually seem to issue common stock rather than buyback. So that's interesting. Dividend is a huge amount of it. So we're seeing probably a little over $1 billion on their dividend side. So maybe that's a 50 to 60% payout ratio of their 5-year average free cash flow. And then it looks like they have been buying back a little bit of debt. So, I mean, that's fine. I mean, I really have to look at year by year whether that was good allocation or not. But I presume that sometime in the last 5 years, the stock has been so cheap, they probably should have bought back shares. So it's interesting to see that they haven't bought shares at all. I think I'm ready to make some assumptions here. I think they're in the telecommunication services. Maybe they'll grow, I'll say 2%, have an 11p. I guess they have pretty much. So we'll say that they grow relatively close to inflation, maybe a tad lower over a 7-year period. And their return on invested capital is pretty great. So I think if they do find something to invest in, it looks like with a slight amount of their cash flow, they do investments. It looks like they do get a solid return on their invested capital and turning it into income and of turning their investments into net income, which is great. And so I think a 13 for a very low growth business after 7 years probably makes sense to me. And then margins, they didn't have too much debt, so I'll probably go pretty close to what the historical averages are, 0%. And then their dividend, we're saying it's 50 to 60%. I'm also saying it's going to grow a little bit. So let's say that it grows relatively in line with their revenue. We're still saying that the company's stock price would have to fall 46% before you get a 15% return, given these assumptions. I mean, I do think this could be a company to add to your A good company to add to a dividend portfolio given the right price. I mean, it's a 4.3% yield right now. It looks like they have produced almost over $1 billion in free cash flow every year since for the last 10 years. And their payout on their dividend in aggregate is probably about 1.1. And so I think that the balance sheet looks great, which is another thing we like to see for dividend companies. We don't like to see a whole lot of debt, and they really don't have that. Their short-term and long-term debt combined is less than 2 years of their five-year average free cash flow. And so, yeah, they don't have a lot of growth, but those are the types of companies that are likely going to be giving out a dividend because their capital allocation is not likely to go towards reinvesting back in themselves because they've almost hit the peak of their growth. And making acquisitions is usually a bad idea in the fact of you usually overpay for what you get. And so in this case, they're just saying, maybe we don't have the greatest opportunities and so many of them, so we're just going to give cash back to the shareholders, and they've been doing it for quite a while. So I see no concern with it. And I think, this would definitely be a company you should put on a list to possibly buy when the price gets to something that makes more sense to you, because then I think you'll get a very solid price appreciation with your solid dividend and excess free cash flow, whether you're in retirement or just like that excess cash flow in your investments. So hope you enjoy the video and have a great rest of your day.